Oddly, consumer sentiment is adjusting in a favorable way, and a turn of expectations with regards to mortgage interest rates. More on this shortly. CPI report comes in and bad news for our market. I'll share more of what you should expect. And lastly, loan market update with James McCann with LoanGo. He'll give us his insights on what to expect on rates and what his side of the industry is seeing in the future of real estate. All this covered here in this week's Market Matters. I'm Karl, your San Diego Realtor. Let's jump into it. Real quick, if you appreciate the information I provide in these videos every week, it would be appreciated if you would subscribe to the channel and like this video. Now on to the good stuff. Fannie Mae recently reported the Purchase Sentiment Index in an encouraging light. The Purchase Sentiment Index is a metric used to reflect the consumer's current view and their expectation of the housing market. Interestingly, 34% of consumers now believe that rates will go up over the next 12 months, while only 29% think rates will go down. Despite the elevated rates and prices, the major government mortgager, Fannie Mae, said, "We're seeing signs that consumers are adjusting their expectations for the housing market to better accommodate the higher mortgage rate and price environment." That's extremely good news to hear, and there's more. Both measures of good time to buy and good time to sell continued upward this last month. The only thing more interesting than this is that things like consumer sentiment, good time to buy, good time to sell are tracked and measured. As much as everyone loved the 3 to 4% interest rate era, it needed to come to an end. And one of the regular conversations I was having with buyers and homeowners was around the possibility of rates coming back down to 3 to 4%. The short and simple, it's extremely unlikely that we will see rates like that during our lifetime. Something major has to happen in the world economy that would require the government to jump in and drop rates that low to encourage spending. And clearly, a lack of spending is not an issue in the US right now. With consumers starting to acclimate to the 7% interest range, this is a good sign for the real estate market. We are still hindered by affordability issues, but we really got to focus on crossing one bridge at a time. If more and more consumers are coming to terms with the range that mortgage interest rates are sitting around, this may allow some of the younger homeowners to come back to the market and list their homes for sale. If this group of homeowners accepts the fact that 3 and 4% interest rates are long and gone, then the hope and wait for them to come back before selling will pass as well. Now, this is pure speculation and something we probably wouldn't see start to happen until mid-2025 due to affordability needing more time to be addressed. And that makes a great segue to the next topic. The CPI, Consumer Price Index report, drops and it is higher than expected. 4% in April, 4% in March. Markets react very aggressively, the 10-year treasury jumping and mortgage rates reacting as well. When the CPI report came in last month, it was higher than expected, but we saw the trend going in the right direction. There was high hope that the April report would show more favorably than it did. Whenever this happens, and by this I mean expectations are not met in these reports, especially the CPI, the market can react hard, and within about 1 to 2 weeks, it does settle back down. Here's the truth of the matter. CPI isn't a metric the government prefers to use to measure the rate of inflation. Wall Street does. On top of that, you also have core CPI, which leaves out energy and food prices due to their volatility and is suggested to be a more accurate measurement of inflation. What you want to take away from this is that Jerome Powell and the Fed's goal is to stabilize inflation at 2% while maximizing employment. If we consider CPI and core CPI, inflation is becoming a bit stagnant. Could it move up again? Yes, it is possible, but nothing like the 8 to 9% inflation rates we saw before. We are clearly not out of the woods yet, and this begs the question as to what Jerome Powell and the Feds will do with rates. Jerome promised 3 cuts, and with the presidential election around the corner, you have to wonder, how will Jerome Powell deliver on that promise while staying on course to meet the 2% inflation rate and maximizing the job market? And while on the topic of rates, let's check in with one of my lenders, James McCann with LoanGo, and see what he has to say about the possibility of rate cuts this year.
So in regards to a rate cut happening sometime this year, I think that's the big question we're all facing. I think everyone's hopeful it's going to happen sooner rather than later. I do think it will happen, especially after the last Fed meeting in March. They decided to hold rates steady, but did promise that they're gonna have 3 cuts before the end of the year. I think it will probably be late Q3, more Q4 this year, and maybe we won't see a full 3, but I definitely think we'll at least see some before the end of the year.
The general consensus is that rates will drop this year, and it seems like that is what everyone is hoping for. There is one person, Jamie Dimon, head of JP Morgan & Chase, who suggests that rates could rise up to 8% due to inflationary pressures such as ongoing fiscal spending, remilitarization of the world, restructured global trade, capital support of the new green economy, and higher energy costs. He cites that though some sectors of the economy have slowed down due to rate hikes, like housing, unemployment remains low, and businesses are still rapidly adding new jobs. It seems like there's so many forces pushing in different directions. CPI reports inflation is up, Feds need to get inflation down, job market is growing strong, unemployment is steady at 4%, and then you have the presidential election right around the corner. You have to wonder, if I was a betting man, where should I place my bet on what will most likely happen to interest rates?
How likely will it be that interest rates are actually cut before the end of the year? I think very likely. I think the expectation is it's going to be towards the end of the year, but I always tell buyers and realtors that we work with, no one has a crystal ball. And so I think that's the expectation among most lenders, most realtors, most people who are in the industry working every day and, watching the market. But there's no for sure's. If anyone could predict this kind of stuff, they'd be on an island somewhere not working in this industry. So I think that it's very likely. I think that we'll at least see 1, potentially up to 3 per the last Fed meeting. But yeah, no one knows for sure. I would say if it does happen, it's going to be towards the end of the year.
Well, I'm glad James gave us some insight on that. Maybe I'll just stick to buying California Lotto tickets. Last item for you, mortgage applications are on the rise, but they are still 23% lower than they were this time last year.
I think the reason for the downfall in mortgage applications is because there are still a lot of people waiting for that interest rate drop. They're sitting on the fence waiting and hoping that rates will come down because they're on the fence for qualifying for the purchase price that they really need to be in. I think that's the big factor that has resulted in mortgage applications being down. Obviously, with rates being higher, that also affects refinances too. There's not as many opportunities there. But I think that a lot of the buyers that are out there right now, if they're waiting, they're waiting for that interest rate drop. And what I'm telling them is when that does eventually happen, it's going to flood the market with buyers and it's going to be so much more competitive. So now is a great time to really take advantage of a little bit less competition, before rates come down and get in and be maybe one of 3 offers and get a price at or below list rather than, have to pay way over market and really, really compete when rates do eventually come down.
James makes a really good point here. There are many buyers I come across who are set on waiting rates out. If they are in a prime position where their rent isn't super high, then yeah, I can see that makes sense if they were saving money. I'm not entirely on James's side on this, though I don't think he's wrong by any means. I believe that another reason mortgage applications are down is due to affordability. Some people have been priced out of the market, simple as that. And unless they come across an inheritance or advance in their career, the market situation isn't looking good for them anytime soon. And that's it for this video. Don't forget to like and subscribe if you haven't already. And if you're thinking of buying or selling anywhere here in San Diego, don't hesitate to reach out. As always, I'm Karl, your San Diego Realtor. I'll see you in the next video.